What's going on, everybody? So today we're gonna be going over today's price action, or pretty much like whatever happened today in the market, during the New York AM session. But specifically, we're doing this because a lot of you guys are gonna encounter certain market conditions that are not gonna be favorable for you guys, and you're gonna be like, "Why is the market doing this?" And you're gonna get frustrated with yourself. And I'm going to explain why markets do these things and how to navigate through these, and pretty much reading price like it's a book. Okay, so reading price like it's a book. All right, so the candlesticks is the language of this specific market, and I'm going to be showing you how to read these. And how you're going to read these is by the concepts that I've taught you guys, dialing it back all the way to the third and fourth video of basic market structure and PD arrays, right? So we're going to be focusing on those two main basic concepts and applying it to reading price in real time. And we are going to be applying all of those things into reading price and ultimately finding price's intended direction. So if we're looking at price right now, right, and we come to, and let's just remove like all of these for now, okay? We come to the 5 minute time frame. We look at price right now, and before 9:30 happens, what do we see? We see price consolidating in a downtrend, right? We're having lower highs and lower lows, right? So obviously that's basic market structure creating a bearish momentum right now. Did we sweep any liquidity? No. Why? Because we are in a bearish sentiment right now. So for us to be long, we need two things. We need us to sweep a major level of liquidity, which is going to be usually a previous session, previous day, high or low. So for us to be bullish, we need to sweep a previous session or day, high or low. So if we come to the 5 minute time frame, the last session that, or the first session that would have occurred before New York would have been London. We already took that out with displacement. Displaced through there, right? Next would be the Asian session, right? So this is going to be this low right here. We get failed displacement, but we do not get displacement over the highs. So what does that mean? We need, remember, we need a break of structure to the upside after we sweep liquidity at the lows, at sell side. So we need, once we get sell side liquidity sweep, we need a buy side liquidity displacement. So we need to displace through some type of swing high or intermediate term high, all right? And do we get that on the 1 minute? No, we do not get any breaks of structure on the 1 minute. Only break of structure that we get is right here. And ultimately, even though we broke this structure here, we didn't get any SMT at the lows. Why? Because we're not bullish. We were bearish, right? So ultimately, looking at this, right? If we're looking at this, we are looking on the 1 minute time frame. What happens on the 1 minute time frame? At 9:30 occurs, this candle opens, market trades down, takes out sell side liquidity. After it takes out sell side liquidity, we displace above this swing high right here, creating our market structure shift right here. Yet we are still bearish. So why is it having a bullish market structure shift? Because it's trying to reach for some type of higher time frame, fair value gap, order block, breaker block, some type of period, right? So we come to the 5 minute time frame. What do we see? Oh, we have an inverse fair value gap that didn't get tapped into, except we had institutional order flow entry drill on it. So that leaves a big void in liquidity for us to grab for extra liquidity for the actual move. So this is known as a turtle soup, which is a higher time frame PD ray mitigation combined with a lower time frame liquidity sweep. So we minus this out, we have all of this buy side right here, which had gotten swept by this 9:30 move. And this is known as a turtle soup, okay? So turtle soup, this is known as a turtle soup where we sweep liquidity on the lower time frame. So we technically swept buy side here in this instance. And we have a higher time frame mitigation. So 5 minute inverse fair value gap would be our higher time frame PD ray. And we mitigated this while at the same time we swept buy side liquidity. And this is known as the turtle soup. And this is one of the most high confluential sweeps that you can have. And this is probably at the same type of level as sweeping some type of time-based liquidity. And remember, time-based liquidity is either a previous session, day, week, or monthly high or low. So anytime you have a turtle soup, this is very high probability for whatever sentiment you are, if you're bullish or bearish, whatever. Okay? So after we get this, we obviously start to dump on the 1 minute time frame. So say we didn't enter on this 5-minute inverse fair value gap, right? What could we have entered right after that? We could have entered on this 1 minute inverse fair value gap right here. Market trades down, disrespects this BISI, which then in return will use this BISI as resistance. So this BISI will now act as a SIBI, which is called an inverse fair value gap now. Price disrespects it, price comes up into it, acts with institutional order flow entry draw at the tip of it, then for that second candle, fills it, respects consequent encroachment of the inverse fair value gap, and then drops down lower and ultimately dumps. It straight up dumps. And this will be our first distribution leg. Now, how do we know this is distribution? How do we know it's not manipulation? We look at here. This is pre-market, right? Ultimately, this is all pre-market right here. All of this. This is all pre-market right here. How do we know it's pre-market? It's pre-9:30. It's pre-9:30, guys. Okay, so anything before 9:30 is known as pre-market. And specifically, since we're talking about the New York session starts at what? 8 o'clock, right? We start at 8 o'clock from all the way back here, right? So we drop down at 8:30 because we had news today. We had unemployment data today, right? So because we had unemployment data today, and also at the same time we have PPI at 8:30, that gives us a manipulation pre-market, creating our low and ultimately our next high of a consolidation. And what is consolidation also known as? Accumulation. See where I'm going with this? You see where I'm going with this, guys? So, we start off with accumulation. Now, what's the next step of the power of 3? Manipulation, right? So for manipulation, if we are bearish, we want to manipulate higher, right? We want to manipulate higher. Now, when we manipulate higher, you can either have one of two types of Judas swings. Remember, Judas swing is just another name for manipulation, right? We can have one of two types of Judas swings. We can either tap into some type of PD ray that is a draw on liquidity for the market algorithm, or number 2, we can take out some type of liquidity. In this instance, what do? We do both. We tap into this 5-minute inverse fair value gap, which was draw on liquidity, and we also tap into taking out buy-side liquidity. And ultimately, that is known as a turtle soup. Having that turtle soup will ultimately be a high confluential sign for us that we are going to be bearish. So, using the power of 3, we have accumulation, pre-market, sweep liquidity, basic market structure here, taking out sell-side liquidity here. Anytime you take out sell-side liquidity, you want to be looking for a bullish displacement, which we get here. This would be our shift in market structure, having our market structure shift, guys, okay? After having that market structure shift, we tap into a higher time frame period, this 5-minute inverse fair value gap, and at the same time, we're taking out buy-side liquidity, all of these buy-side liquidities here, which haven't been taken out yet. And at the same time, we're tapping into a higher time frame period. So anytime you tap into a higher time frame period combined with a lower time frame sweep, that is known as a turtle soup. After we get that turtle soup, we then start to displace down, tap into this 1-minute inverse, and then ultimately displace down all the way down to this 5-minute fair value gap, which was the draw on liquidity during the morning AM session. So because of that, this whole leg would be known as our distribution leg, right? Which is the final step of the power of 3, okay? So we get our accumulation. Remember, we're ranging sideways in a very small range. You don't want to get chopped up in accumulation. Number 2, we get our manipulation, which is what? We get our manipulation by trading above accumulation, the consolidation phase, and we either sweep or mitigate a PD rate or buy side or sell side liquidity. What do? We sweep buy side and we mitigate an inverse fair value gap. In return, we get distribution phase all the way down to the drawn liquidity, which was ultimately this 5-minute fair value gap. And this is the power of 3. Now, how do we know it's the power of 3? Because we used basic market structure of sweeps of liquidity, displacement, and turtle soups. And using all of these basic concepts, we can anticipate where market could possibly be going. So before the distribution leg even comes up, we could anticipate it by having some type of setup up here. And what type of setup could be up here? And that's going to be whatever higher time frame PD ray that hasn't been mitigated, okay? So anytime you have an unmitigated PD ray, that is a possible draw on liquidity for price on the lower time frames. So remember that. Higher time frame PD rays that haven't been tapped in yet has a possible reaction on the lower time frames as the draw on liquidity. Like for example, if we're on the 4-hour right here, and there is a fair value gap right here on the 4-hour, right? Price has the possibility of coming back into it to then trade higher. But on the lower time frames, this is a whole model right here. This is a whole downtrend to uptrend, right? So on the lower time frames, this is what it looks like. It's going from a downtrend all the way to an uptrend. But on the higher time frames, it's actually just a pullback. It's actually just a retracement into some type of PD rate to go higher. Ultimately, it is two totally different concepts of what the market is doing, but ultimately it is the same direction because you are bullish in this scenario and you're bullish in this scenario. But you are both bullish once you get to this objective, which is this fair value gap. Once you get to that fair value gap, you will be bullish. Once you get to this fair value gap on the 5-minute or the 1-minute, whatever, that lower time frame, you will be bullish. So remember, anytime you're trading on the lower time frames, make sure it lines up with the higher time frames, okay? So make sure this, and this are not being objectively against the higher time frames. So like the 5-minute, the 15-minute, the 1-hour, even the 4-hour and the daily, okay? So if you are bearish on the 15-minute and the 1-hour, you want to be looking for a bearish sentiment setup on the 5-minute or the 1-minute, okay? So if we are bearish on the 15, we want to be looking for sells. And using that sentiment, we can be looking for sweeps of liquidity at the highs, displacement at the lows, shifts in market structure at the lows, breaks in market structure at the lows. So we want to be looking for bearish setups, okay? And that's how you can spot the power of 3 right now based off of these basic concepts, breaks of structure, market structure shifts, and liquidity sweeps. And ultimately having possibly turtle soups, okay? So once we reach this 5-minute fair value gap, what do we do now? Imagine we didn't catch this whole trade right here, right? Take a moment. I want you to look at this. What do you think is going to happen? Okay? Could it be a fair value gap? Could it reverse? Could it retrace? What do you think is going to do? Got your answer? Okay, let's go over this. So we have this 5-minute fair value gap, which was the draw on liquidity. Price is going to either retrace into one of two things, or it's going to totally reverse. It's either going to retrace into equilibrium of the range, right? Which is going to be 0.5 or 50% of this range, which is from this high to this low. Remember, when you measure premium and discount, it's from wick to wick, okay? Not body to body, wick to wick. Alright? So it's either going to retrace into equilibrium of the range, which is going to be right here, right? Or it's going to retrace into optimal trade entry, which is from this high to this low. And when you measure optimal trade entry, you measure it from body to body. Premium mid discount, wick to wick, optimal trade entry, body to body. Okay? So it's either going to retrace into 50% of the range, which is right here, or it's going to come into optimal trade entry, which is between the 0.79 and the 0.618 range. And this will ultimately be optimal trade entry. So it's usually going to do one of the two things. When you have your first distribution leg, you have a higher probability chance of price coming into optimal trade entry instead of equilibrium. So remember that. Your first distribution leg, and usually what a first distribution leg is the distribution after the power of 3. And you will have a second distribution leg after you retrace into either equilibrium or optimal trade entry. So how do we know which one is going to do? Since this is the first distribution leg, we can anticipate us coming into at least the 0.618 area. So what we want to look at is we want to look at this fair value gap right here. And if we do not come into this fair value gap, we want to be looking at the next PD rate up, which is going to be this breaker block. So this breaker block will be pretty much the PD rate that is dead smack higher probability because it is touching the 0.705, which is midpoint of optimal trade entry. So this breaker will ultimately be most likely the PD rate that we would come up into. So understanding which PD rate to use is important. Now, would this fair value gap work? Yes. Can you use this fair value gap? Yes. But if you want the most extreme entry possible, you want to be looking at whatever PD rate is sitting at the 0.705 level, which is midpoint of optimal trade entry. Now, if we look at here, price trades down, optimal trade entry right here, between the 0.618 and 0.79. Where does price come into? 0.705, which is midpoint of optimal trade entry. And it wicks it pretty much perfectly. And what does it wick? This breaker that we have previously marked out, right? So we're looking at this breaker from this one. Same breaker here. Now, how do we know price is going to reverse now? And this is not a reversal. It is a retracement into this breaker. How do we know it's not going to push through this breaker? Two things. We want an SMT first. That's the first thing. We want an SMT divergence to happen so we know price is not going to reverse on us. So we know that price is going to be ultimately bearish and it is not going to reverse bullish. So we want that SMT. Where do we have it? Right here. NASDAQ created a high, higher high. Dow Jones, also known as US 30, created a high and a lower high. So we created a lower high on Dow, and we created a higher high on NASDAQ. Same thing here, created a higher high on NASDAQ here, created a lower high on Dow here. So those are both SMTs right there on the 1 minute. So using this SMT, and even we can probably move this SMT to right here, because this is the more recent SMT, right? Which would be from here all the way up here to all the way down right here. Okay, so we can even use this SMT. All right, so because we have an SMT, the next thing we want to see is a market structure shift on whichever market created that higher high. And ultimately, it was NASDAQ that created that higher high. So because NASDAQ created that higher high, we want to see a market structure shift happen at the intermediate term low, or the most recent swing low, which would be this low. So let's play this out in time, okay? We're going to play this out in time, and I'm going to go over this with you guys. I'm going to play it out with you, all right? So this low, we want to see displacement through this low. We have an SMT at the highs here. Once we get that SMT at the highs, we have mitigated a 1 minute PD rate in optimal trade entry. That's already high confluential. To make it even more high confluence, we want to get that SMT. Once we get that SMT, we swept liquidity at the buy side, having a disruption or a mismatch in correlation between Dow and NASDAQ. And that is known as an SMT or a smart money tool because there is a miscorrelation in two markets that should be aligned, meaning that price could possibly reverse now. And that is a high confluential confirmation for us that this is probably a retracement. Once we get that SMT, we are going to be looking for that 2022 model that I have taught you guys to use. Okay, so the 2022 model, right? And that is going to be liquidity sweep, market structure shift, fair value gap. That can be an inverse, that can be a BISI, that can be a SIBI, whatever. But since we're bearish, we're going to be looking for either a SIBI or a fair value gap, or an inverse fair value gap, sorry. So we got our sweep of liquidity right here, which is going to be our SMT right here. We swept buy side, tapped into a higher time frame at OTE. What's the next step? Market structure shift. We want to displace through this sell side liquidity, which is going to be our swing low. Once we displace through this, we get our market structure shift. So let's wait for that. Boom, we get that right here. Market structure shift right here. That's second step done. Easy. Market structure shift on the 1 minute. Once we get that market structure shift, the next thing we're going to be wanting to wait for is a fair value gap to get tapped into. So the highest fair value gap that I can see for myself is going to be this inverse here. This inverse fair value gap is going to be our entry point. Once we tap into here, this is going to be where we enter the trade all the way to most likely sell side liquidity, which will be a 1 to 4 for us. Okay, so if we place a trade right there, okay, once the price comes into here, we can place a trade here, have our stop loss at the high or right above the high, maybe like a tick or two above it, and trade all the way down to sell side liquidity. Now, I'm playing this out in replay. Yes, I am. Is that a problem for you guys? No, it should not be. Why? Because this is an example of what happened today. Now, on the way down, there are portions of the trade where you want to take partial profits. Why? Because if the market reverses on you and comes to your stop loss, it stops you out, yes, but you already took profits. So even though you got stopped out, you're going to be up on the day. And a lot of people don't like partials. Why? Because they like being greedy. Do not be greedy. You want to be happy with whatever profits you can get in. So that's why it's important that you guys lock in certain profits here and there. So, if we're going to use 3 cons, for example, right? We are going to want to have partials at specific points. Where will that be? A 1 to 2 is a good spot to have a partial. So right here. Once we hit a 1 to 2, which is going to be right here, okay, this is a good spot to have a partial. Next spot that's good to have a partial is at the last PD ray, okay? Last PD ray available in that range. That is a good spot to have a partial. And then finally, you're going to want to have your take profit usually at sell side liquidity. Now, you don't have to do it like this. And obviously what you can also do is you can, once you hit sell side liquidity, you can leave a runner. A runner is a last bit of trade going on right after it pushes through sell side because it could possibly continue to dump, right? So because of that, price could possibly still come up and reverse on us. That is why we take the partials. But price could possibly also still continue to dump, even though price has pierced sell side liquidity. And usually what I teach you guys is once it pierces sell side, it could possibly be reversed, which is why I usually take my profits at sell side. So we got our sweep of liquidity with an SMT, with a breaker mitigation, with OTE, with a market structure shift. Now we wait for either a new fair value gap to form or a mitigation at this inverse. So let's let price play out. We get another fair value gap here that formed right with the market structure shift displacement. So we have 2 fair value gaps that have formed, but we are going to be paying attention to this inverse because this is formed before the market structure shift occurred. Okay? Price tapped into the fair value gap. Now let's pay attention. Price pierced through this Now this is invalid now. We're looking at this inverse now. Once this touches this inverse, we are going to enter the trade. Okay? Once we come back into it, we're entering. Boom. Touches it. We are in. Okay? Stop loss right here, right above the high. Full TP all the way at sell side. Okay? Every time we hit these partials, we're going to take one contract off as a partial. Okay? So let's let this thing play out. Alright? Price displaces lower. Boom. You see how we displace with the body close over this. This is known as a break of market structure. Okay? This is our first break of market structure. I'm going to teach you guys something, and this is how I do things. You don't have to do it exactly like me, but this is how I do it. After every break of market structure, what I like to do is I like to move my stops down just a little bit. Just a little. Not so much, because you have to leave the risk on, just in case price wants to maybe come back into this gap, touch it one more time, then continue lower. Or maybe even if price reverses on you, you still want to have your stops with the risk open. Now, every time a break of market structure occurs, I lower it just a little bit until we get to that first partial. Once we get to that first partial, I'm break even on the trade. And that's just how I do things. You don't have to do it exactly like me, but that's how I do it. Alright? So I'm going to play the trade now. Once we get to that first partial, we're going to take off a profit. After we do that, we're going to wait till that second partial, take another profit, and ultimately take that final profit at sell side liquidity. So let's see how price does. Boom. Hit our first partial. We're going to take off a profit. So since we're in a short, we're going to buy one contract back. So take one partial there. So even though we were in on 3 contracts, we were up $3,000. We took a partial off. So now we got a profit of $1,000 on this trade. Now after we took that first partial, I'm going to lower my stops all the way to break even now. Since I have a break even trade now, I can ultimately hold this trade until we get to that second partial, take that second partial, and ultimately hold it until sell side liquidity. So let's see what it does. See how we tap by like the wick, pretty much by the wick at this candle right here. This is the last, or as what you would call resistance happening with retail. That's an example of resistance with retail that's actually working. Why would retail work in this instance? Because we are actually really bearish. So because we're really bearish, retail will work off of regular support and resistance. But when you are all the way up here looking at this, price isn't going to tap off of up close candles to go lower unless it's an order block. You're going to be looking at these down close candles, which would be breakers. Okay? Price is still doing its thing. Price comes back up into this fair value gap. Okay? So we're looking at this SIBI right here. This is what we're looking at right here. Disrespects the SIBI now. Now we're looking at this SIBI here. If price comes into here, we would pull the trade now. Or not pull the trade, we would get stopped here. But there's a reason. Pay attention to this BISI now. Paying attention to this BISI. See how it reacts off of this BISI here. See how it respects consequent encroachment of this BISI. See how it displays through the BISI now. Since it disrespected the BISI, it will act as an inverse fair value gap now. for price to reject off of it. Now this is a potential scale. You could put another entry here or another contract on right now, but we're not going to do that in this example. And we're going to extend this partial profit all the way out here. Same thing with this. We're going to see if it hits it. Almost there. See, hit our partial. Now we will take one more contract off, buy it right there. And finally, we have our last obvious take profit, which will be a full pull at sell side liquidity, which we will now get. Look at that SIBI right here. Watch the reaction off of this SIBI right here. Watch that SIBI right there. See how it's disrespecting it now. And there's a reason we have our stop loss at break even. We have took 2 partials already, and we should possibly have the ability to hit sell side liquidity if possible. If not, and we get stopped here, we are still in profit on the day, which is good for us. Alright? And we get stopped now. So, we did not hit sell side. Why? Because that was not the market's objective. Market wanted to go higher in this instance. But we had the opportunity of taking 2 partials. Now imagine we didn't take these 2 partials. Would we be up $3,000 right now? No, we would not. But because we took that 2 partials, even though we got stopped out on that last contract here, we were able to capitalize off of that, and we were able to, what? Be able to profit $3,000, even though we got stopped. So taking partials is an important concept for you to learn, because you can be profitable on a day you get stopped out on a trade. Just remember that, guys. Alright? So this was pretty much an example of pretty much choppiness in the market during an execution, as well as how to understand where the market could possibly go from here, and how to understand power of 3 with basic market structure and basic PDRs. Alright? So I hope you guys found this video helpful to you guys, and I hope you guys can apply these concepts and this, as well as this example, in when you guys are demo trading, back testing, tape reading, all of that stuff. Alright, so I hope you guys can apply whatever you have learned today, study it in your actual charts, and watch price in real time and see how it reacts with these kind of things. Alright, other than that, I hope you guys have a great rest of your guys' day, and I will talk to you guys later.